what CAPM tells you, CAPM being the capital asset pricing model, is what R is, what that discount rate is. Okay, and so that's what we're going to focus on. Okay, where that discount rate comes from. Okay, so let us do that. And this is basically CAPM. In CAPM, you think about the CAPM, C-A-P-M, capital asset pricing model. Don't say CAPM model, okay, because then you're saying model, okay? CAPM. And we have the idea is that all of the securities, all of the capital assets in the country, in any given economy, are characterized by two numbers, okay? One is their expected return, okay, and one is their volatility, okay, the fluctuation, their risk, okay? The whole idea, the whole contribution of finance in some ways is to domesticate risk, to bring risk into the picture. Just as what general equilibrium theory did was sort of to bring time into the picture, okay? But it didn't really bring time into the picture in a very serious way because it didn't bring risk in the picture, okay? And time is really all about risk, you know, that you don't know the future. And non-probabilistic risk also, okay? Real uncertainty. In CAPM, you're not dealing about non-probabilistic risk. You're dealing with risk, okay? And that's an assumption, and it's not true about the world, okay? But it helps us think about the future, and it's certainly a step ahead. This is the point compared to this, okay? Not having any risk in the story. So in CAPM, you have that's a security, that's a security, that's a security. Securities are points, okay, on this diagram. And you think of creating all the possible portfolios, combining these securities into portfolios, and you can show, therefore, that the collection of portfolios is a set like this, okay? It's a set like that, okay? Now, human beings, this is another assumption of the theory, like expected return, and they don't like risk. Okay, so this is not like your usual utility function where there's goods on both axes. Here there's a good on this axis and there's a bad on that axis. And so the utility curves shape differently, okay? And what CAPM says is you're going to have an equilibrium. This is the sort of analog to the budget line that we had over here, okay? And this is the analog to the production possibilities frontier. It's just the portfolios you can produce with these existing securities, basically. And you can imagine that there are two kinds of people in this world. Okay. Risk-tolerant people. Okay, and less risk tolerant, or we'll say averse, maybe. They're both risk averse. They're just different degrees of risk aversion, and their utility curves go that way. And so they're choosing portfolios here and here. And what does this mean? Now, so this is just reviewing for you your finance. Okay. This portfolio here at the tangency is the market portfolio, okay? The way CAPM works, it says everyone holds the same portfolio of securities, of risky securities. That's the market portfolio here. But depending on your degree of risk aversion, you combine it with more or less of the risk-free security, okay, which is here. So that's why if there's a risk-free security, so you could think of treasury bills here, for example. There's the risk-free rate, and it has a zero volatility. Okay, so that's your risk-free security there. And when I say combining the market portfolio and the risk-free security, you can see right here that person has, you know, anywhere along this line. If you had all risk-free security, you would be sitting here. Okay, if you had no risk-free security and only the market portfolio, you would be sitting here. Okay, so somewhere here is like half and half. Okay, and so what is something up here? Okay, you remember finance. This is somebody who has the market portfolio more than all of their wealth, so they're borrowing. Okay, so they're borrowing in order to hold more of the market portfolio than their wealth. Okay, this is how CAPM works. And this is an equilibrium. And the story of this equilibrium is the equations that go along with this is the security market line, which says that the expected return on any given security, so these are these little securities in here, okay, is just the risk-free rate plus the expected return on the market minus the risk-free rate, okay, this is the risk premium, times beta I, and that's the amount of risk in that security. This is the most famous of the CAPM formulas. I said we're going to be focusing on where does the rate of interest come from, and the rate of interest for any individual security has to do with its beta, okay, with its covariance with the market security, okay, with the market portfolio times this risk premium here. So this is where interest rates come from according to CAPM for individual securities. For our purposes, we're more interested in macroeconomics, so this is the capital market line here, and the capital market line has the equation, if I have this right, it's about portfolios. The expected return on a portfolio, okay, is equal to the risk-free rate plus, again, this ERM minus RF, okay, times the sigma p over sigma m. Okay, this is the ratio of the variance of the portfolio and the variance of the market. Here, that's this here. The formula is not important to memorize. Okay, I'm now going to do this in balance sheets. Okay, so that we can connect it to the money view. So what am I saying here? Let's think about a world in which there are just two people, these two people here. Okay. Each of them has $100 worth of wealth. We have the risk-tolerant person, okay, and what are they doing? Okay, they have let's say both of them have $100 worth of wealth. The risk-tolerant person, I said, puts more than all of their wealth in the market portfolio, and they borrow in order to do that. Okay, so let's say they have 150 in the risky portfolio, and they have 50 in a loan. Okay, so their net worth is 100. Right? And then this risk-averse person, okay, also has, by assumption, net worth of 100, okay, but they have a different portfolio here, okay. They're spreading their wealth between the risk-free and the market portfolio. So they have here 50 in the market portfolio and 50 in the risk-free. And they also have net worth equals 100. Okay? Now I'm going to show you a piece of CAPM that Fisher believed, okay, that is not so standard in teaching CAPM. He said, this 50 is this 50. Okay? This is inside borrowing between private people. It's not treasury bills. There's a bank, okay, that is making a loan and taking deposits. Okay? This was Fisher-Black's way of getting money into the finance story. Okay? He wrote a very famous paper called Banking in a World Without Money, okay, in which he puts forward, actually in words, not in balance sheets, but this sort of picture. It was his very first publication. And this was his image of the world. It's a CAPM image of the world in the sense that the main thing that's going on is people are allocating their wealth. They're allocating their wealth between risky security and a risk-free security. That's the main thing that's going on, okay? And what this bank is doing, okay, is acting as an intermediary, okay, in between the risk averse and the risk tolerant. I have only two people here, but you can imagine in a big economy, what's going on is these loans, you know, maybe they're not really risk-free because these are private agents, not the government. But if you had a portfolio of them and you could figure this out, you know, you could actuarially figure this thing out, and you could make sure you don't lend them more than their wealth or something like that. Maybe you could make them sort of risk-free. And then these deposits are here. So he was imagining this kind of world. Now notice what is important about this world is that the risk-free rate here is the rate that clears this loan market, this risk-free loan market. Okay? So from that point of view, he says, what is this story about the government or the Fed controlling the rate of interest? There's one rate of interest that clears the loan market, okay? And if you had another rate of interest, it wouldn't clear the loan market. So they must be lying or something, you know? It must be a charade, okay? That's the kind of thing he said. So that's one piece, that he has a story here about market determination of the risk-free interest rate, okay? And a story of market determination of the risk premium, okay? Both of these are the two prices that are determined in the capital market. There's no more degrees of freedom for the government to come in and say, no, I'm going to peg the short-term interest rate in this story of the world. So that's one of the things that makes him suspicious about ISLM. Okay. The other thing that makes him suspicious about it is he's thinking about what happens in this world when the price of assets changes. Okay, which is a natural question for somebody coming from finance, right? The price can change for any reason at all, right? It doesn't require accumulation, just a change in expectations, right? This is the point. The future determines the present. These prices are not nailed down firmly, okay? They're fluctuating. You know, volatility is the nature of the world. So ask yourself, what happens if the price of capital goes up? Okay? What happens if the price of capital goes up is that the risk-tolerant person makes money. Okay? The risk-averse person makes money. They both have the market portfolio, so they both make money. The risk-tolerant person makes 3 times as much money. Okay? And now their portfolio is not balanced anymore. You know, if they wanted a ratio of 3 to 1 here, their portfolio is not balanced anymore. Okay? What they want to do, in fact, is now borrow more. Okay? They want to borrow more. Okay? So if PK goes up, you want to borrow more to buy more of the market portfolio. And the opposite is here. Okay? If PK goes up, okay, you now are going to have more risk than you really want to be having. More of your portfolio in the risky thing. And so you want to sell some of that off and buy some more risk-free. So you want to lend more and sell risky assets. Here, borrow more and buy risky assets. Okay? And what that means for banking, right, is an increase on both sides of these balance sheets. You know, borrowing more, lending more, an increase on both sides of these balance sheets for this intermediary. Okay, let me just slow down and tell you what this argument is here. This is saying that in order for capital markets to clear, in order for people to be able to allocate their wealth between risky and risk-free securities freely in an efficient market, okay, it has to be so that the money supply is endogenous. The money supply is endogenous. When prices go up, the money supply goes up. I just showed you, right? The money supply is the liabilities of the banking system. So when prices go up, the money supply goes up. It has to be so. If it didn't, there would be an imbalance in the capital market here. So, so equilibrium in asset markets requires that the money supply is passive. Okay? That's the story he's telling. Okay? That's that 1976, what a non-monetarist thinks. It's this model that he has in his mind, okay, that is leading him to say these really extravagant and strong things that made him a bête noire of the monetarists. And of the economists as well. Okay, he didn't mind being a minority of one. I think he kind of liked it, his personality. Okay, so you see those 2 points. So he said, if you're going to look at the quantity theory of money, okay, you should read it from right to left. Okay, it's the transactions that determine the quantity of money, not the other way around. Okay.